The global financial crisis of 2007 to 2009 was one of the most severe disruptions in modern financial history. The collapse of major financial institutions, widespread market instability, and extensive government intervention exposed significant weaknesses within the international banking system. This study revisits the crisis by examining a central underlying issue: gaming behavior within the banking sector and its regulatory environment. The article re-examines four major explanations associated with the global financial crisis: product complexity, behavioral biases in decision-making, systemic risk, and regulatory arbitrage and capture. It argues that these explanations share a common underlying cause: gaming behavior within the banking sector and its regulators. The increasing complexity of financial products, such as securitization, credit derivatives, and off-balance sheet activities, enabled banks to increase leverage while reducing regulatory capital requirements. Through financial engineering and accounting practices, many banks were able to satisfy Basel regulatory requirements while continuing to maintain substantial underlying risk exposure. Behavioral biases in financial decision-making resulted in incentive structures within banks that encouraged excessive risk-taking, short-term profit maximization, and disaster myopia, whereby financial institutions underestimated the likelihood and severity of extreme market events. As a result, stress testing exercises failed to identify the possibility of the risks becoming systemic. Finally, there is regulatory arbitrage and capture. Banks increasingly exploited loopholes within capital adequacy regulations to minimize reserve requirements without significantly reducing actual risk. At the same time, regulatory authorities in several jurisdictions struggled to respond effectively to rapidly evolving financial practices, limiting effective regulatory oversight and delaying intervention. Overall, this study concludes that the global financial crisis cannot be explained solely by market conditions. Instead, the crisis was significantly shaped by the interaction between product complexity, behavioral biases in decision-making, systemic risk, and regulatory arbitrage and capture. The findings highlight the continuing importance of transparency, accountability, and effective financial regulation in maintaining long-term financial stability. The study considered some possible policy responses. First, changing cultural norms and behavior by establishing that managers of megabanks owe duties of care directly to taxpayers. Second, requiring all participants in financial services, including the regulator, to develop a greater understanding of behavioral psychology in order to help them recognize the behavioral biases that permeate the industry. Third, professional indemnity insurance. Individuals involved in the design of complex products should have professional indemnity insurance, just like other professionals such as lawyers and accountants. However, it seems unlikely that many insurers would be prepared to offer this insurance, which tells us an awful lot. Even if all the policy responses were to be implemented, they are unlikely to be sufficient to stop another global financial crisis.